Over 1 million Americans lost their jobs this year. College graduates are unemployed at record levels. And yet, the stock market keeps hitting all-time highs. Looking at this data, we're watching something historically unusual unfold. Over 1.17 million job cuts announced in 2025, the second highest total in 16 years. November alone saw more than 71,000 layoffs, the third highest monthly reading ever recorded. Even college-educated workers are getting hit hard. Americans with four-year degrees now represent 25.3% of total unemployment, a record high that's double the 2008 levels and worse than 2020. When you plot the year-to-date job cuts through November, that thick blue dotted line for 2025 sits noticeably above most other years except for the 2009 financial crisis line and the 2020 pandemic spike. It's tracking well above the 2022 purple line at the bottom, which marked the tightest labor market in recent memory. More than 60% of Americans genuinely believe we're in a recession, with 68% citing inflation and cost of living as the primary reasons it feels that way. About half say their family members are constantly stressed about money. Yet the S&P 500 keeps grinding to new all-time highs, adding $17 trillion in market cap since April and notching its 29th record close of the year. We just witnessed the 635% plus 6-month rally in the past 30 years. Polymarket has recession odds by 2027 at just 33%, the lowest reading yet. US GDP grew 3.8% year-over-year in Q2, with 1.6% growth in the first half of 2025, nowhere near recessionary territory. The explanation lies in an extraordinary divergence. About 63% of US GDP growth this year came from AI-related spending. Data center spending has tripled since ChatGPT launched in 2022, while spending on all other structures is down 20% from the 2023 peak. We're essentially operating two separate economies: an AI-driven corporate boom and a weakening consumer-driven economy struggling with elevated costs. The top 10% of U.S. stocks now command 76% of the entire market's value. That concentration level approaches the dot-com bubble peak from 2000. Megacap AI winners are dragging the entire index higher regardless of what's happening to the average household. The Fed is cutting rates for the third time this year, but not because big tech needs help. Apple, Microsoft, Nvidia, and the rest are printing money. They're cutting because American households are struggling to service debt, manage expenses, and maintain purchasing power against sticky 3% plus inflation. When you check a FinViz sector map over 6 months, technology and communication services show massive green blocks. Zoom into 3 months and you see more mixed performance. Look at the past week and there's definitely red appearing. But that volatility doesn't change the underlying dynamic. The largest companies dominate index performance like never before, while many Americans are shifting from traditional employment to gig work rather than claiming unemployment benefits. Rate cuts in a weak labor market with persistent inflation above 3% create conditions where nominal asset prices rise. The number goes up on stocks, commodities, real estate, Bitcoin, all moving higher in dollar terms not because the broad economy is firing on all cylinders, but because the largest companies are extraordinarily profitable and command unprecedented index weight. This is why expectations point toward the S&P 500 moving toward 7,000 plus. Even as parking lots at chain steakhouses stay packed with people somehow still spending on $30 plus per pound beef despite maxed-out credit cards. U.S. private sector financial assets relative to GDP tell the story visually. From 1951 through the early 2000s, the ratio stayed relatively contained. Then came quantitative easing, QE 1, 2, 3, and effectively QE infinity through various programs. That line shoots almost vertical from 2008 forward. Asset prices tied to the financial system skyrocketed nominally. Houses, stocks, land, anything with scarcity or productive value went up dramatically in dollar terms. Meanwhile, wages maybe tracked 2 to 4% annual cost of living adjustments, nowhere near enough to keep pace with real inflation in food, housing, healthcare, education, and other essential expenses. The wealth gap widens because one group owns assets that inflate in nominal terms while another group only owns expenses that also inflate. It's the difference between buying a house for $50,000 30 years ago that's now worth $600,000 versus spending all discretionary income on delivery services charging premiums to bring processed food to your door. When tenderloin hits $32 per pound at Costco and a Honda Accord costs $75,000, purchasing power gets absolutely crushed unless you hold assets that benefit from money creation. The uncomfortable reality is that asset ownership provides the only real hedge against this widening gap. Whether it's stocks, commodities, real estate, Bitcoin, precious metals, or productive land, anything with scarcity or productive value tends to rise in nominal terms as monetary supply expands. You don't need to pick the next Nvidia to preserve wealth. You just need to avoid getting steamrolled by inflation eating away at cash savings sitting in accounts earning interest that doesn't come close to matching real price increases across the economy. Claude is AI and can make mistakes. Please double-check responses.